Hello, this is Brian Rezny, President of Rezny Wealth Management, bringing you an important update about the economy and the investment markets. Well, we're firmly into September now, and of course we've got the market that's had a little bit of jitters the last, say, 4 or 5 trading days. As I've talked before, volatility is going to be normal, and I expect continued volatility throughout this year, next year, the next 5, 10, 15 years. Do I expect negative results for the rest of this year? I'm hoping that we start to get some more positive ground as we get into this month of September and then head into the last quarter. Generally speaking, the summer months tend to be very slow trading days, meaning a lot of money managers and traders take extended time off, so the markets tend to be a little more volatile, tend to pull back once in a while, and then usually the month of June or July or August. It's pretty normal. But what happens is when a lot of these money managers and traders come back into town, they kind of get back to work, and what you find is the trading volume usually starts increasing, and generally speaking, things start to stabilize. The economy overall, we looked at a lot of numbers again this morning on our morning research. Things don't look bad at all. The unemployment numbers are good. The job creation is looking good. Are there companies reducing some workforce? There's always companies reducing workforce. I know the media likes to talk about that like there's mass layoffs. If you look at a company like 3M that announced they're going to lay off some people, well, if they reduce their workforce 3,000 people, that's not very many people when you're talking a workforce that's well over a couple 100,000 people. Another company might pick those people up. By the way, there's currently more jobs available than we have workers to fill those jobs. So that actually bodes well for employment and unemployment in general. Remember, when you start to see a lot of unemployment numbers really starting to increase, people going on unemployment and the claims, that could really be a sign of a real slowdown in the U.S. economy. We're not seeing any of that. Generally speaking, manufacturing is doing well. Companies are fairly flush with cash. Overall valuations of most companies are reasonable. I want to hit on one company, which I'm sure most of you have heard of. These would be companies we would never buy as a firm. Companies like Peloton. They have that bicycle you buy at home. You spend like $2,000 or $3,000. You sit in front of a computer screen. The company's never made money. They have massive losses. And the stock basically went straight up like a rocket ship the last couple of years, only to come crashing right back down. So those are the kind of stocks you don't buy. And I will say this, stocks that don't make money, you never want to have in your portfolio. And if you look at the stocks that were hardest hit when we had the correction a few months back, were really these companies not making any money. So we've already had corrections in parts of the market, 60, 70, 80, 90%. Companies like a Peloton. High quality companies that are still making money and still growing, maybe they've come down some, but they haven't come down much, and those are usually companies we want to own or areas of the overall market. When I look at the overall economy again as we get into this last quarter of the year, I really look for greener pastures. And again, the Fed's going to raise rates, in our opinion, probably 50 to 75 basis points in September, followed by maybe another 50 to 75 by the end of the year. But I'm going to say this. The Fed was late raising rates already. They should have started raising rates last year. Would have curbed some of this inflation. So what I see happening as we get into the latter part of this year, and certainly as we get into next year, there is a great potential for the Fed, because they were too late to the party raising rates. They're too late to the party, obviously, really in reducing rates, in our opinion. And I think what's going to happen is they're going to reduce rates actually quicker than most people actually anticipate, maybe as we get into the first or second quarter of next year. The economy is slowing somewhat, which is good. That's going to curb some of the overall high inflationary numbers that we've seen. And if you look at kind of that peak inflation, we kind of really started to see that in that July time frame. So we're starting to see kind of over the hill, cresting over, and some of the overall input costs and costs of general overall inflation to the consumer and business is starting to come down. So that is a positive. It's still too high. The Fed's concerned, but again, when the ball comes over the hill, it picks up speed on the way down. So we see inflation starting to get lesser and lesser and lesser on each successive month as we get through the rest of this year. As we always look at daily research and we look at the economies around the world and we look at the U.S., we continue to still be invested well in the U.S. because we're still the strongest place to be overall, whether it's sector bets or whether it's income bets for the bond side, the income side, or the growth side of the portfolio. We're always looking at places outside the U.S., but right now we're still not seeing any attractive valuations or any places that are less risky with really better opportunity than the U.S. marketplace. As always, if you have any questions about your portfolio or concerns, please call the office and let's talk. We always want to keep you obviously well informed about your portfolio and make sure we answer all of your questions in a timely manner. Make sure you have yourself a safe and profitable day.